My first question is very basic. Is the Evergrande Group's debt issue and their interest payment at the end of this week a systemic risk to the Chinese or global banking systems?
Well, it's great to be with you, Brian. Evergrande is not a systemic risk, but it is an industry-wide event, and it's not over. So I think you're going to continue to see further risk off over the next couple of weeks, and there's going to be a focus on reducing leverage. I don't think you're going to see the government being proactive in bailing out, in bailouts. But the government also, its ultimate goal is to lower systemic risk. And even though this negative sentiment is going to continue, I do want to highlight that the property developer loans are only about 7% of total loans in the system. If we take a look at the overall banking sector in China, Evergrande's debt is around 1.2 trillion renminbi. That's about 41 basis points of total credits in China. But if you actually look at the total loan loss reserve for the first half of the year, it was 340 basis points of bank loans compared to the 41 basis points of total credits in China. So I don't think that this is a systemic risk, and I don't think it's a systemic risk to the banking system. But the volatility is going to continue. I don't think that we're done with this regulatory tightening crusade, and I think the equity volatility will remain high.
I'm going to get back to macro China, Joyce, in just a minute, but first a two-parter. Do you and your team anticipate that Evergrande will miss the upcoming interest payment at the end of this week? And if so, or if not, what happens then?
Well, our base case is for a standstill, and we've seen this before. And frankly, China had started on this process of allowing more corporate defaults in the past. So this had started a couple of years ago. The surprise is that Evergrande is one of the largest ones. And I do think that, Evergrande could be used as an example of what happens when companies, become too big and aggressive in the bond issuing and investing. So I think rather than avoiding a restructuring, I would expect and prepare for a standstill. And I think that China usually doesn't present a problem without having some type of solution in mind. So I think that's the type of workout that markets need to anticipate. I think that, the one thing we are looking at is just the overall default rate and that rising. Now, we've seen about 6 billion of defaults, in the China high yield market, about 4.5%, 5% of that market. And I think that number is going to increase, across the industry. But again, I don't see this as a systemic risk. And I think that the government, will, be able to, manage this. But I think that this tightening is going to continue, and that you do have to expect a rise in default rate.
Yeah, it's big money, 300 billion, but to your point, maybe not to the Chinese government, which brings us back to maybe the more macro issue, Evergrande aside. Now, Joyce, I tweeted out yesterday that it appears that if you sort of look at history, China right now, in the last 18 months or so, is undergoing maybe its greatest political and societal shift since the early to mid-1970s, kind of right under our noses, telling people how long they can play video games, social media, don't list your IPOs in New York, going after CEOs. Does this news give the Chinese government more of a heavy hand and an openness to be able to greater regulate markets, which, to your earlier point, they already aggressively are regulating, which could reduce the attractiveness or the growth of the Chinese economy, which could, of course, hurt the global markets? I mean, there's a lot that I just threw out at you there, but I think you probably get my macro point, hopefully.
Yeah, well, the key buzzwords are common prosperity as their target. And remember, this is a target that they've laid out to achieve by 2035. And there's a couple of things they're trying to do. They're trying to regulate those sectors that have expanded early on. And we've seen this happen in China before. We saw China take actions on the TMT sector, shipping sector early on. So it's the new economy sector. But the other concern is really disposable income, and also the social and consumer welfare. And here, I think you are going to see more regulation that touches things like healthcare, transportation, education, like the high tutoring costs, things that are very expensive for the middle class in China. So what we're going to see is a continued tolerance for short-term pains in exchange for some of these medium-term structural gains. And for the third quarter of the year, on a quarterly basis, we have China's growth basically at zero, at flat. That compares to 10% growth in Europe and about 5% in the U.S., which we've taken down a number of times since July. So we are seeing much weaker growth. Now, just looking at real estate, a 5% slowdown in real estate takes about 0.3% off of China's GDP growth. And this is going to have some knock-on effects. Every 1% down in China's growth is about 0.5% down in global growth. So, I do think that we need to be prepared for, the third quarter slowdown that's underway, but they're going to need to do, I think, more, rate cuts in October, as well, and take some action on the policy side there.
0.3%, not the biggest number in the world, but certainly with an economy their size, it's not nothing as well. I guess what our viewers here watching or listening right now, Joyce, may be wondering is, does all of what we just talked about have a negative impact on our markets? Are you adjusting your S&P 500 price target for this year or next year?
Well, we adjusted the S&P 500 target up, and that's really off of the earnings outlooks.
Wow.
We expect the S&P 500 to reach 4,700, took it up from 4,600 by the end of the year, and surpass 5,000 next year on better than expected earnings. And it's been all about the earnings. I still would say the key to all of this is that, as we look at the Delta variant in 90% of the states, we see the infection rate actually coming down. So we don't see permanent demand destruction here. And we're positive on the equity market outlook. So we've raised the S&P 500 target. We've also raised our EPS estimates from 205 to 210 for 2021. And from 230 to 240 for 2022. So, I would not see this impacting the U.S. market. Now, all of that said, we've taken down third quarter U.S. growth to 5%. I mean, back in July, we had this at 9.5%. So that's 4 percentage points down. But that's still a very healthy number. We do see that the business cycle momentum, where consumer demand is at, household savings, the corporate balance sheet are still very supportive of a business cycle that is certainly not in a late phase. I mean, it's still one that has momentum from here.